Hey, Dr. Jeff Camarda, I've got the market updates for you based on some really interesting articles in the financial press over the past week or so that probably will color our investment decisions as we move into summer. Have a look at what's going on, and remember, we watch the indicators pretty much on a daily basis and stand ready to make changes based on what they tell us. So have a look. You may want to watch this one twice. There's a lot of information in here. I think you'll find the readings of the articles enjoyable. And as always, it's my pleasure to pass this on to you. Thanks for watching. So let's talk about portfolio performance reporting by advisors. First, many consumers don't know how easy it is to become a financial advisor. The government license exams are a pretty low bar. No experience or education is required. Even those with criminal backgrounds can be licensed. And just a few weeks cold with a study guide is often enough to pass the license exams the first time. I think that's really a travesty in this country, but that's not what this video is about. But wealth really is complicated stuff, and Camarda prides itself on very deep education to help clients know what their options are and to make the best decisions for their families. So the reason I bring this up now is for clients who may still have accounts at other advisors or brokers, and for client friends and family and other non-clients that are watching me today. So one big Camarda difference is the rigor and precision of the investment performance that we report to you, calculated to very high standards using both the internal rate of return methodology and time-weighted return formula, each of which give very valuable perspectives. And by the way, the calculations that we put and discuss with you quarterly are done to the time rate of return, the internal rate of return, after all fees and expenses. It's a very real number. Sadly, other advisors, perhaps due to training or non-fiduciary or other shortcoming issues, can tend to wing it when discussing performance, and since if returns seem higher, they look better, actual performance can be overstated, sometime to alarming degrees. So the only way to be sure, and they don't just don't accept the lip service an advisor may pay you if you're in this boat. The only way to be sure is to request in writing performance calculated by the internal rate of return and time-weighted return methods, after all fees and other costs. You get that from Camarda on every statement from us, and you should accept no less from others. On to market summary, and this is second week of June, I think we're in May, something like that. Today is the 8th, the 9th, June 9th. This is the excerpts from 3 recent articles, 2 from the Wall Street Journal and 1 from the Financial Times over there across the pond, in England. Financial Times, very well venerated financial paper. So the first excerpt is from a Wall Street Journal article. This rally is all about a few star stocks, and some investors are worried. And I'm going to read the excerpts verbatim. Major indexes have overcome a series of challenges to power higher this year, but some investors are worried that this performance rests on just a few heavyweight stocks. The S&P 500 has climbed nearly 12% this year, but for some investors and analysts, things don't look so cheery below the surface. Market breadth, which reflects how many stocks participate in a rally, has narrowed, signaling possible trouble ahead. This is a quote, if you look at the S&P 500 index level, you might be fooled into thinking that actually the market is doing really well, that activity is strong, and that profit growth is in full recovery mode, said Seema Shah, Chief Global Strategist at Principal Asset Management. But that would be quite an incorrect reflection of what's actually going on under the surface. 8 of the largest tech and growth companies in the U.S., Alphabet, Google, Amazon, Apple, Meta, Facebook, Microsoft, Netflix, Tesla, and NVIDIA, now like the first trillion-dollar company that produces AI chips, which we have in our all-store portfolio, by the way, now account for 30% of the S&P's market capitalization. That's up from about 22% at the start of the year. And let me underscore that, okay, 500 stocks in the S&P 500, right? People think you're diversified with 500 stocks, but that index is 30% just in 8 stocks. 30%. You see how out of whack that is? How the S&P 500 has fared this year compared to an equal weighted counterpart. If we gave each of the 500 stocks equal weight, which gives sway to every company index, compared with the traditional index's 12% gain, the equally weighted version has added, as of this early, only 2% compared to 12. That's the largest ever outperformance by the S&P on a year-to-date basis, according to Dow Jones market data analysis through June 6th, based on data starting and reporting they began collecting since 1990. So again, what that means is that's the biggest difference between how the 500 stocks did and just a couple of them, that these behemoths that really are kind of wagging the dog. Other indicators of market breadth have also flashed warning signs. The share of S&P 500 stocks closing above 200-day moving averages fell as low as 38% last week. The outsized influence of just a few star stocks can leave the stock market vulnerable to a quick unwind if the tech sector suddenly stumbles or falls from favor, as it did last year and did, quite remarkably back during the dot-com bubble and bust in the early 2000s. That happened, the article mentions, in September 2020, when a sudden reversal in tech shares pushed the S&P 500 down nearly 10% in just 3 weeks. Next article is from the FT, the Financial Times. Handful of tech stocks drive diverging measures of the S&P 500 performance. Forgive the affected British accent. Equal weight version of index slips into negative territory, even though benchmark is up 9.5% this year. By one measure at least, the U.S. stock market has slipped into negative territory since the start of the year. The S&P 500 equally weighted index, which gives equal weight to each stock, has fallen 0.35% since January. This stands in stark contrast to the 9.5% gain for the benchmark S&P 500, where companies with larger market capitalizations, spelled with an S, account for a larger share of the index. There has never been such a strong negative divergence. Rapidly rising demand for the very biggest stocks explains the difference. Riding the AI wave, Nvidia, Microsoft, Alphabet, Apple, Amazon, and Meta have added a total of $3.1 trillion in market cap terms in 2023. Data from AG Bell show, ignoring their contribution, the S&P 500 has shed $286 billion so far this year. That means most of the stocks are down big. High-quality, low-risk tech stocks may also have begun to trade like traditional haven assets such as U.S. Treasuries and the dollar, both of which are beset by doubt. This fellow says, perhaps market participants are more concerned than they look, and the commodity certainly is. Core inflation remains stubbornly sticky, suggesting U.S. Federal Reserve may have to continue raising interest rates or hold them higher for longer to engineer a recession in the next 12 months. The Eurozone, by the way, has already entered recession per the papers this week. Just 12% of S&P 500 companies are outperforming the index on a 60-day trailing basis, the lowest level since at least 1993, according to Liz Ann Sanders, chief investment strategist at Charles Schwab. Quoting actor Michael Caine, Sanders said a surprisingly buoyant S&P 500 now resembles a duck, calm on the surface but paddling like the Dickens underneath. Bull runs in the late 1990s and between 2019 and 21 was similarly driven by a handful of the biggest companies, said Thomas Matthews, markets economist, a capital economist. Stock markets reversed sharply when the dot-com bubble burst. If we're right that growth will falter later this year, we suspect some pain is on the way for the S&P 500 and global equities generally, said Matthews. All right, finally and briefly, thank goodness, shifting back to Americano, another article from the from the Wall Street Journal. Bearish bets, and this is a big one, bearish bets against S&P 500 are surging. Wall Street hasn't been this bearish on the stock market in more than a decade. Hedge funds and other speculative investors have built up a big bet that the S&P 500 will decline, marking their most bearish positioning since 2007. The divergence in positioning reflects the fragility of the 2023 stock market. The S&P 500 is up 12% this year, but it would be negative without the contribution of 7 big tech companies, according to S&P Dow Jones Indices data through the end of May. That potential leaves the index vulnerable to a steep pullback if even one or two big companies misstep. Bets against the S&P 500 have climbed steadily to almost $500 billion, and that certainly is a troubling sign to me. Anyway, thank you so much for watching, and I want to emphasize as you churn through these data points that Camarda again is indicators focused. The trend is the trend until it's not, and we see opportunities to participate in what I think still is a bear market rally, but we're very, very sensitive to making changes when the indicators suggest that is prudent. Anyway, thanks for watching. Until next time, this is Dr. Jeff Camarda signing off.